You can't really fail at it unless you buy the wrong stock or just get excited at the wrong time.
Did you know that Warren Buffett turned a modest $10,000 investment into billions over his lifetime? That's right. Through careful investing, discipline, and a long-term perspective, even a small sum can grow into a fortune. Today, I'll walk you through how you can follow in Buffett's footsteps and potentially turn $10,000 into millions. Get ready to learn the exact strategies that made him one of the wealthiest people in the world. If you're new here, make sure to hit that subscribe button so you never miss out on the best tips for growing your wealth. Today, we're talking about the legendary investor Warren Buffett. He's widely regarded as the greatest investor of all time, having amassed a fortune of over $100 billion. But here's what you might not know. Buffett started small. Early in his career, he wasn't a billionaire. He began with a modest amount of money and, through careful, calculated decisions, built that into one of the largest fortunes in history. Now you might be wondering, how can I, someone who doesn't have millions, use Buffett's strategy? The good news is that you can follow his method with as little as $10,000. In fact, many of Buffett's core principles are built on common sense and discipline. Today, I'll be sharing how these principles can help you grow that initial investment into something much larger. By the end of this video, you'll understand the practical steps you can take to follow in Buffett's footsteps and start your journey toward financial freedom. All right, let's be real. When it comes to investing, many people are held back by fear. It's easy to feel overwhelmed, especially if you're just starting out. You might worry about losing money due to market volatility, or maybe you're unsure of where to begin. Should you invest in stocks? Bonds? Real estate? The choices can seem endless, and without a clear plan, it's easy to make decisions based on emotion, buying when the market is high or selling in a panic when it drops. But here's the thing. This is exactly what Buffett teaches us to avoid. New investors often think they need to act quickly to capitalize on market movements, but Buffett's approach is entirely different. He doesn't try to predict the market's short-term fluctuations. Instead, he focuses on understanding the long-term potential of the companies he invests in. He once said, "The stock market is designed to transfer money from the active to the patient." This means that rather than jumping in and out of the market, your goal should be to find solid, undervalued companies and hold on to them for the long term. Here's an example. Imagine you invested $10,000 in a hot tech stock during a market boom. But then, the stock crashes by 20%, and in a panic, you sell at a loss. This is a common scenario that many inexperienced investors face. In contrast, Buffett would see that crash as an opportunity to buy more shares of the company at a discount. Over time, if the company is fundamentally strong, the stock will recover, and your gains will be much larger than if you had sold in a panic. Historically, the S&P 500 has returned about 7 to 10% annually over the long term. If you invested $10,000 today and averaged a 7% return each year, after 30 years, your $10,000 would grow to about $76,000. But if you manage to follow Buffett's principles and select higher growth stocks, you could see returns that outperform the market average. So, how exactly does Warren Buffett invest? Let's break down his core strategy into 4 simple yet powerful principles. First, let's talk about value investing, which is the cornerstone of Buffett's strategy. Value investing is all about finding companies that are trading for less than their intrinsic value. It's like going shopping during a massive sale. You're buying quality items at a discount. This doesn't mean buying cheap stocks, but rather identifying companies whose market price is temporarily lower than their actual worth. Here's how Buffett does it. He looks for companies with strong fundamentals, things like consistent revenue growth, solid profit margins, and minimal debt. The key is to focus on businesses that have a competitive advantage, also known as a moat, which protects them from competitors. This could be a well-known brand, patented technology, or an unbeatable distribution network. In the 1980s, Buffett bought shares of the Washington Post when it was undervalued. He believed in the company's long-term prospects, and within a few years, his investment quadrupled. The same principle applies to modern-day investments like Apple and Amazon. Both companies were once undervalued compared to their future potential. Number 2, long-term holding. Buffett is famous for saying, "Our favorite holding period is forever." What does this mean for you? It means you shouldn't get caught up in short-term market fluctuations. The idea is to buy good companies and hold on to them for as long as they continue to perform well. When you invest with a long-term mindset, you allow compound interest to work in your favor. The longer you hold your investments, the more your money can grow, and the less impact short-term market fluctuations will have on your overall portfolio. Let's look at the math. If you invest $10,000 in a stock that grows at an annual rate of 10%, which is close to the historical average return of the U.S. stock market after 20 years, your $10,000 would grow to around $67,000. And after 30 years, you're looking at nearly $175,000. Buffett's success is rooted in this idea. He doesn't chase trends. He invests in strong companies and holds them for decades. Coca-Cola, one of Buffett's most famous investments, is a great example. He first invested in the company in 1988, and he still holds the stock today. Number 3, diversification. Buffett often advises against over-diversification, but he still believes in spreading your investments across different sectors to reduce risk. His advice? Own a few companies that you truly understand and believe in, rather than holding dozens of stocks just for the sake of diversification. One way to achieve diversification without spreading yourself too thin is by investing in index funds. Index funds track the performance of a specific market index, like the S&P 500, and include a wide variety of companies from different sectors. These funds have historically returned an average of 10% per year. If you invested $10,000 in an S&P 500 index fund 20 years ago, you'd have around $67,000 today just by letting your money sit and grow along with the broader market. Number 4, do your homework. Buffett doesn't invest in companies he doesn't understand. He spends countless hours studying companies' financial statements, management teams, and long-term business prospects. This is why he stays away from speculative investments and focuses on businesses with clear, understandable models. He has famously avoided investments like cryptocurrency, not because they can't generate returns, but because he doesn't fully understand the underlying value of these assets. Instead, he sticks to what he knows: consumer goods, insurance, railroads, and energy companies, industries that have stood the test of time. Now, let's take a closer look at one of Buffett's most famous investments, Coca-Cola. In 1988, Coca-Cola's stock was undervalued, and Buffett saw an opportunity. He believed in the company's long-term growth potential and understood its global appeal. So, he invested a whopping $1 billion in the company. At the time, many analysts thought Buffett was crazy for investing so much in a beverage company. But he knew Coca-Cola had a strong brand, a wide distribution network, and consistent cash flow. Fast forward to today, and that initial $1 billion investment has turned into over $25 billion. If you had invested just $10,000 in Coca-Cola when Buffett did, today you'd have over $250,000. This is the power of patience, value investing, and holding on to great companies for the long term. So how can you apply this to your investments? Before you invest in a company, ask yourself these questions. Do I understand what the company does? Does the company have a competitive advantage? Is it consistently profitable? I'd love to hear from you. Drop your thoughts in the comments below. And don't forget to check out my next video where I break down even more investment strategies to help you grow your wealth. Thanks for watching, and until next time, happy investing.